Where we left off was talking about nominal exchange rates. And the thing is that if you understand what's going on with nominal exchange rates, you'll be okay for the remaining topics in the class. But economists actually talk about real exchange rates, which may sound a little strange. These are actually real or relative prices, and the term real price may sound extremely strange to you. And, well, it is strange. It's because to examine real behavior, you don't actually care about the level of prices, you care about their relative level. You care about whether prices are high or low relative to some other price. And what we were talking about, for example, with the Big Mac, you care about whether a U.S. Big Mac is more costly or less costly compared to, say, a Chinese Big Mac. You care about the relative price. And so the real exchange rate just measures that, whereas a nominal exchange rate really does not. We saw that the nominal exchange rate may fall over time. This is a long-run kind of thing if inflation is more rapid than inflation is abroad. And if it does, so that the law of one price holds, then U.S. goods aren't cheaper than foreign goods, or vice versa. This is an argument about there being no arbitrage. But what if the law of one price doesn't always hold? And in fact, it actually kind of never does. So what if we aren't in long-run equilibrium yet, and U.S. exports are either a better or worse deal than other countries' exports? We want to devise a measure of a real price that captures this, and this is going to be the real exchange rate. This is going to be confusing. Like I said, I think if you understand the whole point of the exchange rate changing in a particular way and making goods more or less expensive in the short run, then we're fine here. The real exchange rate is going to be defined as the nominal exchange rate, E. So RER is the real exchange rate. It's equal to E, the nominal exchange rate, times the ratio of domestic to foreign price levels. And when the law of one price holds, this is rigged to give us 1, that the real exchange rate will just be equal to 1 when the law of one price is operative. So E is equal to PW over P when you've got the law of one price working. And if you substitute that in, you will see that this gives you a real exchange rate equal to 1. But in the short run, if prices of the goods are sticky, then if the nominal exchange rate falls on its own, it lowers the real exchange rate also if again, these prices don't change. And that lowers the real price of U.S. goods in the short run and makes exports a better deal because their prices haven't yet risen. We know they should over time, given arbitrage that should open up. So if the real price of U.S. goods falls, then our net exports should rise. People are buying more of our goods relative to other goods. And because there's expanded demand for those goods, their prices will rise relative to others, and that should equilibrate everything. That ultimately the real exchange rate should return back to 1. It shouldn't be less than 1 in this instance when the nominal exchange rate is temporarily lower. It will rise back to 1 because prices are changing and eliminating arbitrage. Well, what determines exchange rates in the short run? The fact is that a lot of things, a lot of buyers and sellers, and it's not just price levels that are determining exchange rates. Global currency markets are absolutely massive. The amount that is traded daily is about $2 trillion, and that's about 12 times the amount of daily global production. So daily GDP is 1/12 that level. Well, who trades currencies? Exporters, importers, savers, people who want to move their cash around the world to increase their capital returns. So there are a lot of people out there involved in all of this. And we're going to think about the demand for dollars in the foreign exchange market or the demand for other types of currency as being open to change when these groups demand to particular types of currencies depending on what's happening to real interest rates. The supplies of these currencies are basically fixed in the case of the dollar by the Federal Reserve, our central bank. In the case of foreign currencies, those are basically fixed by the foreign central banks. So supply is not going to be changing. This is all demand driven. The changes in the demand for dollars or for other currencies based on what's happening into real interest rates will then lead to changes in exchange rates. In the short run, we will assume that prices are sticky, so that any change in the nominal exchange rate will become a change in the real exchange rate. So, the real exchange rate concept is true, and it's there, and you should know it, but it's not as important as the basic concept of the exchange rate, the nominal exchange rate changing. So that's how we're going to argue that there will be changes in net exports. It's an argument technically about the real relative price, the real exchange rate. When our currency temporarily depreciates, it's not because suddenly there has been a change in the price level. Namely, our prices are higher now, so we have a higher rate of inflation. That's a long run story. If in the short run our currency depreciates, that will stimulate our net exports because in fact, our prices of goods have not changed. It's only the exchange rate that has changed, and that leads toward increased net exports. This, incidentally, as a side note, is exactly what we think the Fed is trying to do right now with monetary policy. Perhaps not intentionally, they won't admit it, but if monetary policy results in a currency depreciation for us, that will result then in more net exports, more U.S. net exports, and more GDP for us, which is kind of what we need right now. The conceptual roadmap then of what this means for the short-run model looks like the following. There are going to be domestic financial conditions, here and abroad it turns out. So there's the real interest rate, let's say in this country, for example, and that stimulates more or less demand for domestic currency. If the real interest rate here is temporarily higher than it usually is, that will spur savers around the world to demand more dollars and try to get some of that action because they like higher rates of return. That will push the price of dollars, which is the nominal exchange rate, up. So in other words, if our real interest rate rises, that will lead to a currency appreciation because our rates of return are higher. International savers want dollar-denominated assets, so they want dollars to get those, and that pushes the price of dollars, which is the exchange rate, higher because demand is higher. That raises the real exchange rate, which is true. Again, it's not kind of the focal point of all this, and that technically is what raises net exports. I'm sorry, I misspoke. That will lower net exports in this example. If the real interest rate rises, the demand for domestic currency, the dollar, rises, our currency will appreciate. And if our currency appreciates, the dollar is now more expensive, the price of it is higher. And I'm sorry, so that will result in a reduction in net exports because our goods are more expensive. You can see that I get this mixed up sometimes too, and I have to just be very careful about how things are working and what I'm saying and getting the right directions, and that's a common problem. That then will lead into changes in the IS curve and aggregate demand. And the trick is going to be thinking about whether we began all this with domestic financial conditions changing, namely the real interest rate here, or we could start the story with international financial conditions, namely the real interest rate in another country changing. And those two things have very different effects on the ISMP diagram. Well, why do domestic financial market conditions affect the demand for dollars? Well, think about somebody with savings, a saver who wants to earn a return on his or her savings, and this could be any person from any country. In the long run, the marginal product of capital, which is what that person earns on their capital investments, should be the same in different countries with similar credit markets. So maybe the saver is ambivalent in the long run about where to invest. But suppose that in the short run, suppose the U.S. real interest rate rises above the marginal product of capital. What should the saver then do? Probably buy up U.S. assets because they pay a higher real return. In order to buy more assets, however, in the U.S., the saver needs to translate savings into dollars. So he or she needs to demand dollars from the local bank, which raises the demand for dollars. So the story is that a rise in the domestic real interest rate relative to the foreign real interest rate will raise the demand for dollars because it attracts more foreign savings, more cash that must flow in here because people want to earn that rate of return that's higher here. Well, how does higher dollar demand affect the economy? The price must rise if the demand for dollars increases. And that is an appreciation of the dollar. In the short run, price levels of goods remain fixed. So that means that the real exchange rate also rises. And that's just another way of saying that it's more expensive to buy U.S. goods than it used to be because their prices have not equilibrated, to kind of offset all this. When the real exchange rate rises, the demand for U.S. exports will fall because the real price of U.S. goods has risen. And why is that? Well, technically, the real exchange rate is equal to the nominal exchange rate times the ratio of prices. And when that rises above 1, it's not profitable to export U.S. goods abroad because their exchange rate price is too high. The price levels themselves have not changed, but the exchange rate has. It has risen. And so you're not gaining by exporting goods abroad, you're losing actually. U.S. demand for imports rises because they're a better deal. So you can look at it either way here, that exports fall, imports rise. It pushes you in the exact same direction with net exports. It really, either way you want to look at it, it doesn't matter. It will get you to the end of the story in the correct way. So when U.S. exports fall because they're more expensive and U.S. imports rise, net exports will fall and aggregate demand will fall. So putting all these pieces together, we see that real interest rates also affect net exports, not just investment. When the domestic real interest rate rises, savers want to move their savings to the United States, so they demand dollars. The dollar appreciates, the nominal and real exchange rates both rise. And the real exchange rate you can think of as being the real price of U.S. goods. So U.S. goods undergo this inflation, so to speak. I mean, the fact is they haven't, but the point is that they are more expensive relative to other goods. And that results in the following. Net exports will fall because the real price of U.S. goods has risen. And so it's bad in the short run in terms of production. In reverse, when the domestic real interest rate falls, savers want to move their savings abroad, and that sounds like that might be bad for the economy. They demand fewer dollars. But because the dollar depreciates and the exchange rates both fall, net exports actually rise. So this is actually a good thing in the short run in terms of economic production. It may not be good, of course, for consumers. It may also not be good for inflation because imports are part of consumption. And so if you measure consumption good inflation, then that might be a problem. But it's actually turns out that it might be good in the short run to have a depreciation of the dollar because of the real interest rate falling. Even though what's really happening is that people are moving their savings out of the U.S. into foreign denominated assets, foreign currency denominated assets, I should say. So the thing to keep in mind here is that changes in foreign real interest rates have similar but opposite effects. So I could tell this same story for the real interest rate, let's say in Europe, that is set by the European Central Bank. And the results for us would be exactly opposite. The results for the European economy would be the equivalent of what they are for our economy here. But of course, what we're typically doing is thinking about what the actions of another central bank abroad would have on us rather than on them. And so things kind of have these mirror opposite effects that's important to keep in mind. Exchange rates can also react to fear, and we saw this last time. Here, now, everybody was cutting interest rates in the financial crisis, but it looks like what happened is that the overall effect was an increase in the price of the dollar, an appreciation here following the crisis because investors worldwide, or I should have said savers here technically, flock to dollar assets because they seek safety and they view government bonds issued by the United States as being the most credit risk free. So that's this story, which is a little bit of a different one. Well, how do we incorporate these changes into the short-run model? It turns out that visually nothing will change in the ISMP graphs. So they will look exactly the same. The IS curve will still slope down just like a demand curve will, but two things will change. The magnitude of the slope of the IS curve will be different because net exports now respond to the real interest rate that's set domestically. And what shifts the IS curve and the aggregate demand curve, have we covered that? That's in chapter 12. What shifts the IS curve will also now include changes in foreign real interest rates and thus changes in foreign monetary policy. And that will affect the domestic economy. Those will, in fact, be aggregate demand shocks. So the breadth of stories that we can tell, I should have written, sorry, this is the ISMP curve. We are not covering the aggregate supply and aggregate demand framework. The breadth of stories that we can tell will widen. And so that's our next task, is to move into thinking about the ISMP diagram when there are changes in foreign monetary policy or domestic monetary policy.